Um, one thing I find it interesting, a bull market usually is initially led by gold prices, and then it starts to spread across the riskier parts of the market. And it is remarkable that since April 21st of this year, gold has sort of peaked, right? And it's gone sideways essentially, as you can see in this chart. That's the yellow line. And you can see at the blue line, it's the precious metals explorers. I think that's the best proxy for this is the TSX Venture, looking at this specifically at the sub-industry group of precious metals. And so you can see that's up about 30%, while gold is essentially flat, as I said. I do think that's the beginning of in my view, the beginning of outperformance trend of this industry and this part of the industry, and it's starting to trickle down, as you can see, in our own portfolio, but also in this index alone is remarkable to see this type of returns despite this downward or downside or a sideways movement in the gold price. Let's go to the next chart. And this chart now is something that comes to my mind as far as appreciation for what's been happening recently, where we've had an environment where metal prices have been very high relative to energy costs. And that speaks volumes about margins of most mining companies. And we're seeing this now with all sorts of companies reporting earnings more recently and surprising the market on the upside with margins continuing to expand. And so every day you see these margins, or I should say, the gold to oil ratio staying at one of the highest levels in history, or something that people don't talk about often. But it's not just gold, it really is silver. And you can even put copper into this chart as well. I didn't want to too busy of a chart, but even copper prices relative to oil look historically high. And so essentially, in my view, is it means that every day we spend on this ratio remaining at these levels, at least, it means that these companies are going to be most likely continuing to have very strong margins moving forward. So this is, in my view, also an opportunity for a lot of these companies to be hedging their energy costs, but also extending to see this type of earnings releases that we're seeing in some of the major companies. And I'm going to show a few of those companies here, and it's not to pick individually in some of them, but it's more to show some of these stocks that have very long history. Are fascinating to see this trend that they've been breaking out of, and I think it's just the early stages of a much bigger move. Let's go to the next chart. So in the next chart, I'm just showing something I've been updating recently as we get these earnings reports from most of the major companies. In this case, we're looking at the 50 largest mining companies in the Canadian and U.S. stock exchange because they have easier data to analyze. And as you can see, the blue bars is looking at the median all-in sustaining cost. And all-in sustaining costs, and some people have issues with that because it doesn't include some other things that are certainly important when it comes to looking at the overall structure of cost of an own business. But despite that, and its own flaws, you can see the gold prices in yellow are clearly substantially higher than those blue bars. We probably have not seen anything like this in a very long time. I like to call this the golden age of mining that I think we're entering. And that's just because of this production margin is it's something I have not experienced in my career, and I think majority of us either watching this or living through this era have also not seen this, even going back to the 1970s. Just if you go back real quick to the prior chart, one thing that is remarkable about this as well is that in the prior chart, the gold to oil ratio or the gold to silver ratio, we're not anywhere close to this levels that we are today compared to what we saw back in the early 2000s. And so, this just trying to show that these types of profitability that we're seeing across these companies is something very unique. I won't call unprecedented, but I will call unique to this era. And maybe it's a perfect storm, given not storm, but perfect a setting, given the fact that there's so much skepticism towards this industry. And usually skepticism is built over a long period of time of negative events in this industry. Certainly, misallocation of capital, depleting capital, and all sorts of things that have caused this industry to carry that burden of being capital bleeders and not necessarily have leverage to gold prices, of which leverage works both ways. We've seen historically leverage work in a very bad way for the mining industry. Therefore, this reputation, this negative reputation. But now we're starting to see the other side of this, and it seems to me that skepticism remains much higher or more prominent than the actual results that we're seeing. Therefore, why these positive surprises are probably just getting started. Let's go to the next chart. In the next chart, you're looking at the silver mining industry. I think Kevin doesn't like this junior miners, but it is the name of the ETF. SILJ is just one vehicle that you can invest in, and supposedly smaller companies in the juniors in the silver space that have higher exposure to silver. Now, it's not a perfect ETF, because bunch of these companies, not all of them have, a silver exposure. If you're an investor in the space, it is very difficult to find a company that owns a project with basically primary metal being mined being silver. And so it is a difficult a vehicle to build. However, doing our best and seeing companies that have very large exposure to silver relative to others, uh, and looking at that relative to the actual metal price, you're just starting to see this line break a downward trend, and potentially usually. Well, why do I show these lines? And you see a few of those in this presentation, is because when you have those breaks, you tend to see historically a momentum in prices on either the upside or the downside, depending on how the line has been broken. In this case, I believe that this is a real breakout, and potentially we could see much higher prices. And as we see the leverage to metal prices working on the positive side, not the negative side this time around. Again, cycles change, and if we are not in a bull market for gold and silver and copper and others, the leverage would work the other way. It is not my view, and I don't think it's the view of the firm. And so why we have conviction on buying companies that are in the mining space. Let's go to the next chart. Next chart is showing for illustrative purposes only. You can see a chart that shows basically stages of a bubble. And in this case, you know, if I would point out where we are here, I think we're maybe transitioning away from where the smart money has been accumulating capital and deploying and allocating into these assets, and starting to see the awareness from what is called awareness phase, but it's where institutional investors are beginning to either ask questions, start to deploy capital into this industry, and I think that's what's called in this stages of a bubble, the takeoff phase. And I believe we're still in that, starting to get into that part of it. I mean, we can argue where we are here, but that's just my sense of I think we have a pretty good pulse of this market, given our position here as allocators in this industry, and for being, as Kevin said, it's been 5 years that we've been in this potentially the smart money phase of accumulating assets in this industry. And so this takeoff phase is potentially just getting started. And again, just views for illustrative purposes only. This is not a perfect framework for an industry or anything like that. Let's go next chart. All right, next chart, we're looking at the largest North American silver mining company today. And why am I showing this? Is because I like these charts that have very long history. There are not a lot of companies out there. Mining industry is a very complex space, and a lot of companies go bankrupt during the wrong times of the cycle. And so it is important when you have a company that has endured during multiple cycles in this industry. And so in this case, we have a Hecla Mining that goes back to all the way to the 80s in this chart. And if you draw a line all the way from the very peak of that moment when we saw silver prices approaching $50 an ounce and so forth. Today we just broke that downward trend. I mean, it's a again, it's been a very difficult period. Although we've had some eras like the early 2000s that were very beneficial for the mining space. Still, the margins that we're seeing today are nowhere close to what we saw back in those days, and so it is to me a very important aspect that we're seeing the break of a major downward trend potentially if we continue to see these moves. I mean, this chart is a quarterly candle chart, and so it's a very long term and completely ignoring the daily moves in not ignoring, but I should say reducing the relevance of short term moves is probably the right way to describe this. And so, in fact, the next chart is looking at not in the silver space, but in the gold space and copper space. I find it interesting that Barrick changed its name from Barrick Gold to Barrick Mining just because of their large exposure to copper as well. But we can say that these things happen in different parts of the cycle as well. And I'm not going to get into that, but the point being is that Barrick is also starting to break out, and I noticed this in a few moments in prior presentations. If you listen to these presentations in the past, and I think it's just the beginning again of a bigger move. And Barrick has been a big lagger for the right reasons, by the way. In my view, but eventually, as I said, eventually the money trickles down into this whole industry, and even companies that investors have been very skeptical about it are also starting to make money, and Barrick is no different in this case. It's been certainly fundamentally improving over time, and I think that this breakout looks really attractive and compelling as well. Let's go to the next chart. Now we're seeing something that happened recently with refined copper, removal from the tariff situation, and therefore copper prices collapse about 20% in one day after going up. By about 10 or 15% in one day as well, and it forcing a lot of questions here now. Gold as well, seeing these tariffs imposed in the U.S. for bars, gold bars, potentially related to the situation between Switzerland and the United States in terms of trade agreements. But I'm not going to even get into that. My point is, if you're an investor in this industry and you're seeing gold prices continuing to do well, and and there's a lot of concerns when you have copper prices declining as much as they did, in that day. And in my view, as I usually say, you can borrow someone's thesis all day long. You can say, well, I think what Tavi or what Kevin or what Quentin is saying looks very compelling, and maybe I'm going to start investing in this industry. A lot of people do that, right? Not just with us, but with other folks and that speak their views in about markets. But it's really where build wealth, in my view, is being able to take advantage of these market fluctuations of which none of us have control over, and that level of volatility that you tend to see, of which is in a lot of ways unjustifiable given the long-term trend that we may see. I mean, if as you can see this chart, the whole point of it is showing, look, gold and copper move very close to each other over time. If gold continues to do well, in our view, copper should also perform very well. And so, as we see these types of volatility events, I think those are more windows of opportunities rather than the other way around. So I'm not scared of volatility. I think we should, as investors, embrace it. In fact, and so that's my point. Let's go to the next chart. In the next chart, I think, if you ask me, this is the most important macro chart that is, important here. Some of them, some folks like to just watch, some others like to invest, and some others like to just have a view. I don't care where you fall into those categories. This chart is um, very relevant for macro views, and the dollar holds the key for a lot of different themes, macroeconomically speaking. And in my view, the DXY index is just a basket of currencies with a lot of weight in the euro, the British pound, the Japanese yen, and some other developed economies. But those three are really the main part of it. And what you're seeing here is a very long-term trend where the dollar price has versus those currencies have performed very well. And perhaps the whole idea of bringing capital into the U.S. as we see the dollar as well performing so strong throughout those decades. And in my opinion, this I think these cycles, just like any other cycles, and why they're called cycles is because they move from an upward trend to a downward trend, and then from an upward trend again to now a downward trend. And I think it's sometimes difficult to envision, the dollar being, now the best of all dirty clothes out there, and perhaps entering a downward cycle is maybe difficult to imagine. But I firmly believe that if we want to fix the trade balance issue and the deficit issue that we have on the fiscal imbalance, it is almost inevitable and unavoidable, in my opinion, that the dollar needs to be devalued substantially relative to other currencies. And so, in my view, since we've had a big decline here in this DXY index, we hit the major support line. And an investor, it would be normal to see some level of a bounce. We did see a bounce, and now what? Now we go up from here, or do we continue on the downward trend and break that support and go a lot lower? My view is the latter. No, my view is that this is the beginning of a multi-year downward trend for the dollar. And what I find it fascinating about macro is that you can sort of, a lot of times it's very difficult to see a trend that unleashes all at once. I think, as I said before, my belief is that investments is all a way of accepting. It's an exercise of acceptance of risk. And a lot of times it's one currency or asset class that tends to have an easier thesis to understand from an institutional standpoint, is the one that leads the pack, and then you tend to see the unleashing of others. In the case of precious metals was gold, and then you're seeing how other metals start to follow, and things like royalty companies, and then the senior producers, and then that have done their homework, and then the other senior producers that have not done their homework are now moving, the junior miners, the explorers. And so you start to see this trickle down of acceptance of risk. The same thing happens here. So if you go to the next chart, which ones are those currency pairs that have started to make a major move? Well, the euro has certainly started to move. So the US dollar has been depreciating relative to the euro, as it shows in this chart. Already broke that trend line, as you can see. If you go to the next one, it shows the British pound. It also does the same. And in fact, this recent appreciation that we saw of the dollar relative to the British pound only retested this support that is now going to become a major resistance, in my view. And so, if you are of that opinion, you would think that candles are going to continue to move on the downward trajectory here. And again, these are just views. Nobody has a crystal ball to really know if that's the case, and we're just using uh, political and fiscal constraints to and macro constraints to have an opinion on these asset classes that are so important to unleash other ideas that I'll talk about in a minute. If you go to the next chart, I'll show you another one that has not moved as much. I mean, that's the Japanese yen. The Japanese yen, if we use the same idea, the Japanese yen remains at a very high level relative to these other currencies that have already and no, in my view, likely to retest that line again and go even break that at some point. And why we're seeing the 30-year yield in Japan is starting to move, and all these long-term yields are starting to move in that are likely to give even.
Tavi, your sound's cutting out a little bit now. See if he can get that fixed up.
Am I back? Can you hear me okay?
Now you're back.
All right, I'm sorry. I'm sorry. So I was talking about the Japanese. If we go to the next chart, in what shows is that the Japanese yen had one of its largest appreciations and on last Friday on a daily basis. The last time we saw this was when the BOJ started to loosen up their yield curve controls situation, allowing the 10-year yield in that case to start running to the upside. And people said, well, they're losing control over things and so forth. The BOJ doesn't have control. I actually think that what's happening, they're allowing those yields to move a lot higher because it doesn't really matter, especially the 30-year side doesn't matter as much in regards to what's been happening with their situation on the debt front. Majority of the terming of their debt is actually way below the 30-year, and the average maturity is way below 30-year. So the rise of the 30-year yield is sort of irrelevant. In fact, the only thing it does, it gives further support to the Japanese yen to rise. And so, as you can see here, I do think that this is more. We're going to see these moves more often, not less often. So again, just my opinion. Let's go to the next chart. Another currency pair that I think is making a really significant move, and I think it's again also part of this trend as well. And I'll speak a little quickly about this. But the Brazilian real is one of the best performing currencies this year, and in my opinion, is also going the same direction of the euro and the British pound and potentially the Japanese yen, eventually touching that support line, which in this case is at around 5 or so level. And if so, I do think eventually we break that line and go much lower. Again, an acceptance of risk. It starts with the euro, starts with the British pound, and then you start going down into the riskier parts of the market to make a play on the potential domino fall of these currencies. Let's go to the next chart. As if you take a look now, I was looking at US dollar versus let's go to the next chart real quick. But if you go to we're looking at the Brazilian real in the prior one, but this one is actually an equal weighted index of a lot of emerging market currencies. And you can see now we're looking at the opposite way, just to don't confuse your mind, but we're looking at the opposite way of what we were looking at before. So the fact that this chart is going up, it means that the emerging market currencies are actually outperforming the dollar. What I find fascinating about this chart is that there's a very, very long-term downward trend as well. We broke out of that and retested the line again, and and it's normal. We've had a bunch of Brazilian equities, Chilean equities, Argentinian equities. All of these things actually sold off recently, and again, you're being tested on your thesis, but ultimately, I think these things continue to move on the upward trajectory. And this break that you're seeing here, I believe, is a real break. and will likely create momentum on the upside, not the other way around. Let's go to the next chart. And the next chart, I've just shown the something fascinating as well is what's been happening politically and the structural changes we're seeing in Argentina. To me, are remarkable, really. And what we're seeing in terms of credit creation in the private sector there is surging, as you can see this in this chart. Is something to be aware of. It's something that we also saw in the prior emerging market cycle or downward movement of the dollar or bullish environment for commodities, hard assets, gold. All these things are very linked. It is important to see. Now we're seeing something similar to what we saw in the mining industry, right? We saw, some specific companies that have better margins, arguably even better management and so forth, is starting to attract capital before some other major companies. And now, that money, as I said, is starting to trickle down into other parts of the industry with higher risk. The same thing is probably happening in emerging markets. The fact that we're seeing the structural shifts in Argentina taking place, and in a way, they've been doing their homework. They're attracting capital first, and so usually why you see this is outperformance in their stock market as well, relative to other places. But eventually, I think it's gonna flow through the whole region. That's my 2 cents. Let's go to the next chart. All right. Well, this is an important thing. Stephen Moran was, potentially, who knows if he's going to become the Fed chair, but he's in a very strong position to potentially become the Fed chair, and has done a lot of work and in terms of sharing his macro opinions and so forth. And what I find it interesting about all this is what we are likely to see potentially with interest rates. And if we go to the next chart, one of the things I had high conviction from the beginning of the life, I would say last year or so, is that the 2-year yields are going to continue to fall. I thought we would see the development of this trend much quicker, and so I'm a little shocked that, or surprised, not shocked, but surprised that we haven't seen a bigger move on the downside of the 2-year yield. But I still think that's eventually going to be the case. We're going to see, in my opinion, much lower yields in the short end of the curve, in order to basically apply fiscal dominance in a certain way, and reducing interest payment on the debt, and allowing this increasing non-mandatory is increasing, potentially, or as I like to say, pro-growth spending is likely to increase as we see the interest payment on the debt substantially being reduced by lowering rates. And I do think that eventually we're going to get into that path. Now, there's two sides of this. There's Jay Powell's side, of which likes to say inflation has not gone away, or you have the other side of Trump saying that we need to reduce rates because we can't afford these interest rates. I think both sides are right. No, I would argue that both sides have a point. So, I'll try to make my point quickly here. Go to the next chart. Quickly, if you want to find a reason to lower rates on the unemployment side, I know there has been a lot of questions about the data and so forth. I do think the unemployment rate, or unemployment, or labor markets have been deteriorating. And you can see this by several ways. In fact, I think these numbers from GDP are much weaker than under the surface than a lot of people are believing recently, with saying that especially tech investors, you hear them a lot of times talk about GDP numbers, perhaps without doing as much work in terms of what is really driving that data. And if you take out what's been happening with imports and exports, majority of the data does not look like, especially from a personal consumption standpoint, that the economy is really booming. And so it doesn't surprise me that labor markets are in fact deteriorating. And the numbers you're seeing in the screen are two examples. On the top line, you're looking at the ISM employment, which has nothing to do, and is really a survey across managers in the manufacturing space. And the second side of it is the second panel here. We're looking at unemployment rate as usually they cross that 3-year moving average, we tend to see a upward movement in unemployment rates being supposedly continuing to happen. So I think that's going to be the case. That's my view on this. But let's go to the next chart, because one thing that Jay Powell likes to say is that inflation is not contained. I don't disagree with him, and I cannot understand why people were saying that. And I think this is a little bit imposed by the media as well, that inflation is being cured. The problem is being cured. And I don't think at all that's the case. I mean, if you look at commodity prices equal weighted, I mean, forget about egg prices or oil prices or metal prices. I'm not talking about one specific commodity. Let's look at the whole basket together and weight this equally and see where we are. Well, we're up about 12%, double digits in 1 year. So, that's your real inflation. That's your real inflation that this enters the system in a large way. That's your real world inflation, not the CPI. And so, in my view, that's something Jay Powell is not wrong. I mean, yeah, inflation has not been cured at all. The problem is still with us, and very likely to stay with us for the long for the long term. Anyways, let's go to the next chart, because the commodities equal weighted index tends to be as well potentially a leading indicator for inflation expectations. When you look at the market expectation for inflation on the 10-year yield, which are 10-year break evens, that tries to price where they think the CPI rate will be. And there's a very strong correlation throughout history between commodities and inflation expectation. And recently, we're seeing the divergence of the two, but inflation expectations are starting to catch up with the red line. In my opinion, that's just the beginning. In my opinion, we're going to see a very significant catch up on the white line with the red line, particularly with all that it's happening. I mean, money supply making new highs. We're now. The situation with the Fed, forcing the Fed's hand to potentially reduce rates on the face of all this. I mean, this is what I call a supercharged environment for hard assets. In fact, if you go to the next chart, what is even more fascinating is what's been happening with this revaluation of gold discussion. His name is principal economist at the Fed, Colin Weiss, has reported this paper, of which, and I'll give hat tip to Luke Groman. That was the first person I saw that posted this paper, and I start looking deeper and deeper into this. But basically gives accounting steps even and ways to how this whole revaluation would occur. It goes back into many other instances in history where other countries have done that. And the bottom line of this that he says is, the whole point of the paper is to say that, look, I mean, these things are your last resort type of policy, one, and that it doesn't structurally fix the issue. Now, I don't disagree with that. Now, do we have a lot of options? I don't think so. I think eventually, and I would say that there's a lot of expectations that at some point the Treasury will perform this revaluation of gold. And if that's the case, I think it's likely to happen much earlier than people think. And so eventually, I think this is going to be a very important policy that will take place. But that, again, that's just my opinion.